so right now, of course, many pundits have been calling a bubble in the funding environment for a long time. We all like to talk about bubbles, so let's get right to the bubble talk. And so right now, there's no doubt some tremors of some sort. Okay. No one really knows what's going to happen, obviously. So I'd like for you guys to kind of give us your feel of what's going on in the funding environment. Should we be worried? Is this a tremor? Thank you for the chair. Is this a tremor, or is this the beginning of a giant earthquake? I'm going to start with Hans.
I think the popular answer is that, oh my God, the sky's falling. And a lot of people on the sideline can't wait for a lot of shit to fall.
Yeah.
I don't think that will happen. So I'll start with that. We have seen valuation correction in a lot of deals this quarter versus last quarter. On average, probably anywhere between 20-25% to 1/3 of the ask. I've seen companies that go out Q4 last year asking for maybe 2x, 3x last round, ends up doing around that flat round. So that's what's happening. But at the same time, all of us that have been through earlier cycles in 2000 and 2008 feel like it's the best time to do a startup because your competitor is not going to be able to raise money. So that's competition, better environment. Okay. So it works both ways.
Does anyone disagree with anything Hans said? I encourage you to do so.
Supplement your comment from a different perspective. In tech industry, yes, I think what you said is right. But apart from the TMT tech industry, I also do deals in biotech, life sciences industry, healthcare IT, where technology converges with healthcare. In fact, I think the valuation is still pretty high. And
don't invest in that. Don't invest in it. That's a TMT. Founders is better.
Yeah, I know. But you know, as you probably noticed, you know, there's a correction in the biotech life sciences industry in the U.S. And the prediction is the wave will come to China at some time. Yeah.
Probably soon.
Yeah.
We're in the very early stage, so ZhenFund. And I know a lot of you guys are entrepreneurs. I'm just curious, does the market environment, and yes, it's harder than last year, does that affect if you do a startup or not? If it doesn't affect your decision to do a startup, can you raise your hand? I'm just curious. That's okay. So I think the real entrepreneurs, they don't look at, you know, really the temperament of the market. They're really trying to solve a problem. So I think most entrepreneurs.
That was a minority. Everybody else.
Who would stop?
Who's affected? Who says check it out and not want to do start out anymore?
Come
on, be brave enough and raise your hand. All right. Hey, only one honest person here.
This was the next Jack Ma, but now.
So because the reason I say that is because I see all the VCs slowing down in the Valley and here. I hear about, I don't know if it happened to GGV, but you know, a lot of firms, they're canceling their IC meetings. You know, people are much more cautious than before. But at the early stage, I still see all these wonderful entrepreneurs every day, and I keep waiting for it to slow down. You know, frankly, I would love to like slow down a little bit. But these amazing people keep coming through the office, and I think it's because there's still so many problems to solve. So all these entrepreneurs, you know, they want to still keep doing it. And once you're an entrepreneur, it's very hard to go back, right? And I still think the best deals are getting around. I mean, like Hans was telling me, you guys just Poshmark, you know, they're still, one of our deals just got a $1.7 million round that just closed last month. So I think the really good deals are absolutely getting new rounds. But I think we do have a few that are dying. And I think the market is actually allowing people to be like, okay, we're going to close down or we're going to move on. So I think that's a nice adjustment as well.
Okay, so I think it sounds like we all agree that the market is a little overfunded, right? We'd all agree that the market is overfunded.
It was.
What's that?
It was.
It was. but not necessarily still currently. So already adjusted, quite possibly.
We went to an upfront summit in LA in February, and they did a survey, and 60% and 70% of people who went to the summit, and these are VCs, were pessimistic about fundraising, about getting deals done. Most of them don't want to do deals for the rest of this year. And just to echo Anna's point, that's ridiculous. Obviously, it's easy for us to say we closed over $1.25 billion fund just recently, but if you have the money, this is the best time to invest. That's some of the best companies were funded in 2008, 2009, whether it's Uba or JD or Xiaomi, were all funded right after the financial crisis.
To talk a little bit about your fund, $1.25 billion fund they just raised. I hope you guys caught that. Tell me a little bit about some of the conversations you had with LPs. What were their concerns? What were they asking?
The number one concern for every single LP is, when are we getting our money back? Sure, I'm getting more money, but over the last 5 years, how much money we've given you and other people, when are we getting our money back? Every LP is looking for distribution, and a lot of them are scared that all the money that put into emerging market funds, they're not seeing cash distribution. So for all of us, despite the fact that we're aggressive of looking at new investments, we do think about how to generate liquidity. Every Monday meeting we talk about that.
Right. I imagine it's something all of you, even at the early stage, or actually even more so at the early stage, that you guys are struggling with, where startups are staying startups much longer, right? And therefore, liquidity will come much further out, and therefore your LPs who are expecting distributions at 8 years or 10 years or 12 years or wherever isn't going to be having. Maybe we're talking about some of you have more younger funds, but do you have LP concerns related to the term?
I think that's the opposite for angel funds, because like for us, we already distributed our Fund 1 this year, and the reason is because we can sell startups to VCs. Like I can sell a share to Hans right now.
I'll think about it.
Let's do that.
We sell our deals.
You give me a discount, sure.
Sometimes we take 10% off and we sell during Series C or Series D to other VC funds. And then also we have some smaller exits, like 40 million or something, and we still make, like 5 to 8x from those. So we have the opportunity to exit throughout the stage.
Yeah, we're also really early stage, a little bit earlier than Anna actually. And for us, actually I just ran into an LP yesterday. I didn't realize he was an LP, and he was making fun of me saying we're an evergreen fund, which for those of you who don't know, basically means you reinvest what you make, which is not true because we have distributed capital to them. Just on the fundraising side, I think LPs, actually I'm finding that in the US for our space, which is very early stage, I am getting a lot of comments like, they want to basically decrease the number of managers. They'd rather invest in much larger funds like GGV. They are sort of concerned, sort of like sub $100 million funds. What is your competitive advantage and what is your liquidity? But for China, I don't find that to be the case at all. We're actually all over Asia Pac. Just traveled to Japan, Hong Kong, Taiwan, and just have a lot of people interested still in the very, very early stage space, actually.
All right, let me change topics a little bit. The environment is right now potentially a tightening funding environment. And one might say, many say that the risk is greater at the top for the unicorns to be able to raise another round that's going to be greater than the last and a higher valuation. And people are calling, of course, I'm probably referring, if you haven't noticed, I'm referring to Bill Gurley's article, which I actually read word for word. Who else read word for word? I want to know. Who else read word for word? Yeah, like 2 people. It's epic.
He repeated everything.
For people like me,
it
it takes repeating to learn. Okay, so let's talk about unicorns. Where do you think they're going? There's 150. Hans is invested in 10% of them. 10% of them, or GGV, I guess, has 10% of the unicorns. But not just for Hans. What's going to happen to these unicorns? I mean, are they going to be able to raise another round? Is down rounds going to become much more common?
Lawyer's perspective?
Yeah.
My understanding is in the US, the SEC actually has started investigations on some of the fundraising activities of the unicorns. I also participated in the fundraising of some of the unicorns representing investors. One thing I found, which is a little bit disturbing, is usually if you are not one of the big investors, if you're just institutional or wealthy individual, there are a lot of middlemen coming to you to say, oh, okay, here is a great, a great opportunity, and that's the valuation. Would you like to come in? And basically, you don't really have much negotiation power. They would say, okay, Goldman Sachs already, they are the lead investors. Here is the term sheet. Take it or leave it, type of thing.
Yeah.
And the due diligence you can conduct is also very limited.
Yeah. So, from your lawyer opinion, how far out do you feel like is the SEC from actually acting on these unicorns raising huge rounds in the private markets and not IPO?
Well, it just started, and so I cannot predict now. I will be happy to give you a report next time.
Okay. But we'll have to pay for it, that report. See, drop out in the next year or so. I mean, just run out of cash and not be able to raise. Or am I totally blowing this out of proportion?
I think also, you guys are talking about unicorn, but let me just put a slightly different perspective. I think unicorn, we actually, because we invest in both in China and Japan, I see some market differences. So markets like Japan actually have several unicorns using the definition that's been used for the past, say, 10 years with venture-backed and so on. But many of them actually are now public companies. And the reason is, in markets like Japan, companies do not raise Series D and E. Most of them actually go public much earlier than the equivalent companies in China and US. So unicorns do exist in Japan, but many of them are actually public companies. So it's actually very different type of unicorns, because public company unicorns, yes, they do get market valuation adjustment, but they don't drop like freefall, as in the case of private, still privately funded unicorns. So I think some of the ones we are seeing, both in US and China, the really publicly, but still not public, private round companies. Some of it actually, has had a lot of hype in the past, but their performance has not caught up with the previous hype. And I think those ones have, of course, been punished. But I still think that the private ones in US and China that actually still have fundamentals. So maybe they're not going to get as much premium as they did a year ago, but if they have, strong fundamentals, these companies, are still going to survive.
Especially if they've been invested by GGV or
especially if it's been backed by Anna personally.
I keep on telling myself that if I go to bed. Public market, both in US and China, especially in the US, a lot of companies' valuations have dropped a lot since the beginning of this year. Look at the hedge funds. If they have a positive return in the first quarter, they're already considered pretty impressive. For the public unicorns, the valuation drop has been even more dramatic than private ones. For the private ones, I think out of the 150 you mentioned, account for both US and China, most will be raising funds, but that means 40-50% will be raising funds at very close to last round price. Uber.
Hear that everyone? That's a tidbit. Tweet that.
More than 50% will be raising funds at last round price.
Flat round.
And that's for companies that are doing well. Companies that are not going to be doing well definitely will have downwards. Look at India, what's happening in the e-commerce market. Both companies are going through issues. Amazon is investing aggressively in India. So and also the sort of market growth has slowed down. In China, with smartphone penetration reaching more of a plateau amongst the tier 1, tier 2, tier 3 users, growth is slowing down as well. And you look at some of the mega companies like Facebook. Facebook grew 45% last year, its revenue, and that size, 45%. That's mind-boggling. So you do see the big company taking a giant share of the growth in some of those categories. So whatever you do today, you have to be very different than what the big boys are going to be doing. We still think those companies exist, but each thing will look very different than it has been in the last 10 years.
Of course, raising it higher is with somewhat what he's calling a dirty term sheet, right? You got all sorts of downside. The VC puts in all sorts of downside protections.
I think
how
when we
should
just
they
build
evaluate
term sheet, I laugh.
Yeah,
not
because everybody's writing dirty term sheet.
In China, every term sheet, every term sheet has a deficit. Every term sheet has liquidation profit plus participation.
Yeah.
I mean, what world has he been living in?
Yeah, exactly. Exactly. Okay, well, instead of answering the question, we just made fun of him early. Probably more
He's a smart guy, but come on, that comment was out of context.
Seriously, I agree. Okay, but seriously, I mean, how concerned should entrepreneurs be in a tight fundraising environment? How concerned should they be with these downside protections? Should they just accept it and say, this is what I have to do to get through this period of time? Or what? What are the other options are?
Can I just say that as very, very early stage investors, basically like at least in the US, if you look at Crunchbase data, you have a 0.9% chance of becoming a unicorn. So if you have the opportunity to worry about those, special like pre-IPO guaranteed returns or whatever, then good for you because you're part of that less than 1%.
Well, downside protections, they're still in early stage companies too, right? I mean, you tell me.
Far less. Yeah.
Not at all.
I think
you don't have anything more than basic liquidation preference. I mean, tell me what's the standard, some of your standard terms?
We're super founder friendly, so we don't have really any of this stuff. But even, like as Hud said, even some of the dirty terms like Bill Gurley's talking about, you could look on. I think Fenwick and West does. Sorry, your competitor does this venture deals survey, and every quarter they put out like what specific terms, like what percentage of the term sheets are they in. So you'll see, series voting, what percentage of term sheets these are in, liquidation preferences greater than X times, etc. So you can see that they do all exist, and you can actually see the trend as well. So I agree with Hans that except for maybe guaranteed IPO returns, like a lot of those things are pretty standard, and you don't see them in at least pre-A stuff. That's kind of ridiculous.
I think in the Valley over the last, ever since 2008, 2009, there were a lot of entrepreneurs that ended up going to be raising their angel funds and start investing like entrepreneurs do. So for them, the Valley went back to having 1x liquidation preference, but no participation, which means that if I invest at 10 million and the valuation ends up being more than 20 million, I don't have liquidation preference anymore as an investor. And a lot of these ex-entrepreneur seed funds just get used to doing that and getting into interesting deals at the beginning of the mobile internet revolution, that they can get away with that kind of terms. But if you look at what will happen in the next few years, I think the Valley probably will go through some adjustment to become more of what's like pre-2008 somewhat. And that's what we're really is referring to. And you can also read about other people's response to his comment, his post. One of which I really like is saying that he's frustrated, and just speculation, that he's frustrated that Uber hasn't gone public.
Yeah.
Because he keep on wanting, Uber keep on wanting to raise money, fighting 3 wars in Southeast Asia, India, and China, when it easily could have just made strategic investments in these 3 places and move on and not burn so much cash. And there's nothing, Bill and other people who invest in Uber can do about it. Because all the terms that put in are so founder friendly, made it impossible to prevent an emperor do something crazy.
Actually, I have a question for you. So in the past, I've seen like U.S. services are much more founder-friendly than the ones in China. Is that gap narrowing or widening? What do you see?
Question. I think up until last year, it was widening. I think now it's gap is closing.
Which is coming closer to which?
Closer to China a bit more. But I think in China, you do see liquidation with participation. In US, you don't see that as often. So that is still the norm right now. Well, how it will change in the next 5 years, we'll see. But in China, with BAT so strong, I think it's harder for founders to not give that up to the VCs.
Anna, do you have anything to say on that? You do a lot of early stage China.
Also, redemption rights. That's a lot. But I don't think they have that in the US as much either. And in China, it's pretty standard.
150%, 5 years,
Explain to us
pretty
what
standard.
you're- I don't know what it works.
So like usually it's after 5 years, they have the opportunity to buy or to get the money back, or to give the money back. They have to give the money back.
So you invest $5 million in your company today, 5 years from now, you have an IPO, no exit, I probably can get 7.5, I have a right to $7.5 million back for my investment, 1.5x. On average, it's like, 7%, 8% yield per year.
Okay.
I don't really see it being exercised that often. I haven't really, but it's always in there. I mean, for us, we have a one-page term sheet. We got rid of all the liquidation and everything, but I think and we thought more people were going to follow us, but not that many people are following us. I think.
What are some of the most important, some key metrics that you like to see in startups that you invest in, especially for those of you in early stage investing? Like, I know 500 Startups has a very clear equation. You hit these numbers and we invest or not. Can we talk about some metrics? What are some, and this is also for advice giving for all those that are kind of early stage. What do you need to hit to be able to raise a seed from these people or an A? So can somebody start out with some metrics?
So our official party line is that, I'm just saying it varies so much from business to business that like it's kind of pointless, but our official party line is about 50% of the companies coming through our accelerator and making more than $10,000 a month, which like, it could be...
Revenue.
Yeah, revenue,
Not
exactly.
making money.
No,
Generating sales.
yeah, so like, basically, but it really depends because, we have a lot of fintech companies that are pre-launch because there's a lot of regulatory hurdles. I mean, you would literally go to jail if you launch certain things. So, and then, if you're e-commerce, and you're certain verticals, you're doing $10,000 a month, that's probably not that interesting. So it really depends. I don't know a good answer to this. I would just say you should really compare with the business model and vertical that you're in, right? Like if you're a marketplace, then try to benchmark yourself against that for seed funding. And it varies so much from geography to geography as well.
So we actually invest a lot in early stage e-commerce and also social media type companies. So maybe I'll talk about, since she mentioned revenue, I'll talk about a company with no revenue. And we actually do have some tools, like we investors in Akio, so sometimes I use their analytics tool to just see what's happening in the similar categories and to do some of this kind of benchmark stuff. At the very simplest level, we still look at DAU growth and retention. These are the two, probably the most basic numbers that I would look at it. Then from there, you can actually look at so the growth, organic versus non-organic, and also look at factors like, well, if it's a social app, or how much of a buyer coefficient actually does it actually have today? And all those are basically the numbers. Actually, I shouldn't care about it. The same numbers the founders themselves should care about, because if you don't know those numbers, you don't have like pulse on your business. But these are the ones we look at for social media type companies.
For us, I don't think most of the time we don't even get to the metric stage. So like Little Red Book Social, which we did with Hans, came in later. But that was just a guy who came in and said he had this dream to do a travel company, and I've known him for many years, and it's just someone you believe in, and so you give them money. Hover camera launched today at GMIC, which was very popular. There was similarly a guy who was doing coupons at the time, and I didn't like the idea, but I really was touched by the guy, and he ended up pivoting to doing this hover camera, which finally launched it after like 2 years. But it was a very successful launch. So I think most of the time we don't even get to the metric stage. Miaba Meizai, some of our most popular companies, they weren't even registered when we invested. So for us, it's really about the founder. And then sometimes, I'd say maybe 30-40% of our companies are when they have absolutely nothing. And then the rest, when they do have metrics, is exactly what Akio and Barrett were saying.
But if the company has no metrics, it's just a founder, then what do you actually look at inside?
We have I wouldn't call it a formula, but we really look at the founder's potential. Like, is this $1 billion founder?
What does a $1 billion founder do?
Yeah, please tell us.
It looks like you.
One good example is on the I'm a Unicorn show that both Anna and I were on. There was this girl and I say girl, not a woman, because she's only, what, 17 years old?
Yeah.
And when she come out and talk about the stuff she does, the e-commerce company she's building, very social, very viral, for people of her age. I mean, she's only 17 years old. I mean, is she a $1 billion founder? At this point, no. But she's just so outstanding as a 17-year-old, all of us were happy to give her money. So that was a clear case of is someone extremely precocious. Even if what he or she would be doing didn't seem like it could be super big, or they're just not experienced enough, you feel compelled to give them money. And Xiaohongshu is a very good example. Sharwin was probably the smartest MBA student I interviewed during the year, summer of 2012. Clearly, just most impressive. And it was a very strong crop that year as well. And when he first did his first startup, Xiaohongshu's first inclination was travel startup. Travel startup is extremely hard to do, very low frequency of usage. So somebody who never done startup before, this goes into a category that's very low frequency of usage. In general, you should be investing in that company. But GSR and ZhenFund put some money in them. And then for Series A that came around, GSR thought for a long time, and the last second, actually after the term expired, decided to invest. And it was not easy to make that call. And when we invested in Series B, it was still within 1 year of the company's history, they kind of morphed into cross-border e-commerce. Except that there's no commerce. There were a few promotions. On the site, you see very good content that's user-generated. That's very interesting. It's kind of sticky. People read it often, but there was no monetization. And people who invest in cross-border e-commerce back then, a lot of people invested in other companies that actually had commerce and were generating revenue. This one was not. But everyone that we looked at, all of it still liked Xiaohongshu the best, because when they do the promotion, conversion rate was 15%. That's unheard of in mobile commerce. The average is talking about 1%, 2% at best. If you do 3%, it's actually pretty good. So if someone who does promotion from time to time can do 15%, do you want to make that bet on a team that have no prior experience in e-commerce at all? Most people didn't. And that's a rational decision. But a year and a half later, they become the most fastest growing social commerce company in the world. So go figure. And that's why investing is fun. Because you can look at the same situation, same set data point, and draw 180-degree complete different conclusions. Xiaomi, Series A, B, C, every round is expensive. It's expensive still today. Every single round is expensive. You can invest or not. That's why it's fun.
And we're right all the time.
Maybe she is.
All right. Let's talk a little bit about China. You're a U.S. company to come to China, or for a Chinese company to go to the U.S. Anybody? Equally hard, and don't tell me it depends on the vertical, because of course I know it depends on the vertical.
It's less dependent on vertical. I mean, granted, if you're in the media business or social networking business,
yes,
it's hard, period.
Yeah.
And it's almost mission impossible. Maybe if you're someone who can jog in Tiananmen Square in the morning, which is so foggy,
Learn Chinese in 2
or teach a lecture in Chinese, then maybe it'd be different. But other than that, it's mission impossible in social media. But you look at what Uber has done. I mean, as much as we're investing in DD and want DD to do well and like DD, it's impressive to see this crazy guy spend so much money to fight a war in China, and in some cases it's doing pretty well. So if Uber hasn't been doing as well, I think everybody knew it would be so pessimistic about China. But the fact that travelers can do something here when no one expected them to do anything at all 2 years ago, it's already a huge achievement. And it makes it easier for Airbnb and others that we're backing to come. And I think that during the Chinese consumption upgrade phase, you will see interesting brands from Europe and US getting Chinese money to help them to come into this market.
So, but do you think in a way the success of Uber was that they didn't do the same thing that other previous American, European companies
They act like Chinese company.
They became Chinese.
They became Chinese. This is the most Chinese company around the world that's not Chinese.
Yeah.
So
and that
exactly. So that makes it a lot more interesting. And that's just a very good case to teach I'll do this company that, hey, this is what you need to do. Are you ready for it?
But at the same time, I think it's actually sometimes both culturally and ethically hard for American companies to act really Chinese.
Very, very much so. And that's why it's interesting for us to play a role.
But then what about your company musically that's like blowing up in the US?
Right.
And its Chinese team so local, such a
Musically it's fascinating because you meet them and they're very unassuming, very understated. But you talk to the Chief Product Officer Alex Zhu and the CEO Louis Yang, the way they think about product is very methodical, very systematic. So they have the American product manager's systematic approach towards doing things. Yet they're armed with knowledge of both Chinese market practice and US market. So they understand virtual items, and they understand social psychology extremely well. So this is a team that went to US and beat teams from US and Europe in the lip sync music video space.
Actually, I visited the team in Shanghai about a year ago. I was so impressed. The products are American. When I went to this little house, they were working out of their ground floor of the founder's house, and the family was living upstairs. It was like very un-American place. And I didn't see a single American-like person.
No white person on the team.
It was just completely, for me it was a cultural shock. Wow, how can this team create such an American product? So I think it's possible, but again, it's just like Uber becoming Chinese. I think these guys are also not a common player here. It's very rare.
I think increasingly you probably see more Chinese professionals who have worked both in the US and China and decided to come back to China to do their startup. And those stuff that have done that 5 years ago is not considered, you have a Haigui in China is not very good 5 years ago. But Haigui now, who operate in both markets, is in a very good place because the world's going global. And for the next 10 years, it'll be interesting to have teams that will have a more United Nation background, whether in the US or in China. I think in the US,
What about 5 Mile?
we can talk about that, yeah. So in the US, originally people want to back a team that's very mainstream. Talk about mainstream American deals on San Road, whether it's Facebook or it's Twitter, cool guys that are techno bros that graduated from Harvard or Stanford or Ivy League. I think over the next 5-10 years, you won't see more of that succeed. They will still get funded because the VC will still like those kind of deals. But increasingly, the ones that are more United Nation background, more first-generation immigrants that come from countries around the world, will likely to build the next unicorn. But over the next 10 years, because the world is going global. There are 3 billion smart devices worldwide that's connected on the internet. If you just focus on the US market, it's just not going to be big enough.
Any other thoughts on the difficulty of going cross-border?
Can I just add something on that? Because we invest, so our portfolio is about 61% US and 39% international. And the international is across 62 different countries. So I think that for China companies going to the US, there's a lot of desire, but less sort of expertise, help, or funding. But for US companies coming to China, I mean, I feel like, I think every sort of Silicon Valley headquartered investor, or nowadays Israeli-based investor, probably gets hounded with which one of your portfolio companies wants to come to China? We will fund them, we will set up a JV, we will do everything for them, et cetera, et cetera. So I think it's great that Uber is doing really well here, and so are some of the other leading internet companies that have set up separate Chinese structures and were able to hire locally, incentivize locally, and have access to a lot of resources. So I feel like China is very welcoming of international companies. I'm waiting for our portfolio to get more comfortable coming here. So
Wendy is going to have the last word tonight.
Yeah.
We're out of town.
I just want to add that in this cross-border movement, I think VC firms like all you guys really play a very, very important role, because as you said, US companies, when they move to China, they need people to help them to localize and also to get the resources in and to understand and adapt, and maybe even grow from M&A transactions.
Okay. Well, I think that's all the time we have. Thank you so much to our speakers. You guys were amazing. You guys and gals, excuse me, were amazing. And it was a pleasure to be here.
That's great. Thank you so much. Really appreciate it.
Thank you.